Hello everybody. Hello everybody. Hopefully everything records well. Again, this is Ken Krager from Black Swan Financial Advisors. Everything or anything in this video on my website in print is for educational and information purposes only. So please remember that. So anyway, I woke up in the middle of the night and I was thinking about this legacy planning situation, and it's really been bothering me the last couple days because of some friends that I was talking to over the weekend. And so I wanted to do a video. I'll probably end up doing a couple of videos about legacy planning and ensuring the future financial security of the loved one with special needs, and how important it is to put some legal and financial structure in place in order for your loved one to have a successful future after you've gone. So I'm going to talk a little bit about, well, what is legacy planning and why is it important? There's legal and financial aspects to this, and probably one of the biggest things that people might not realize is probate. I'm in Arizona. If you have more than $75,000 of assets or you own a home, doesn't matter how much the home is worth, your estate will go through probate unless you have a trust. And right now, typical probates take more than a year. And I've heard, those horror stories of people's assets being tied up for even years in probate. And the government gets to take part in deciding what happens to your assets and so forth. So probate, if for no other reason than to keep the government out of your business and not tie up your assets so that your loved ones can use them immediately, then legacy planning is super important. The other thing is that circumstances change. The siblings, the brothers and sisters of your child with disabilities, they're going to grow up, they're going to get married, they're going to have their own families, they're going to have jobs, they're going to move maybe far away, and the circumstances change, and you just don't know whether or not it's even going to be feasible for the brother or sister that you thought would be taking care of their sister or brother, that it would even be possible. And so I'll talk a little bit about that. And then the other reality is that there are disagreements and fights. I mean, we're talking typically about a lot of money. And for every situation that I've heard where the siblings are taking care of their loved ones, and I mean, this is in normal families and normal estate situations where estates are transitioning from one generation to the other. For every success, I've heard a lot of failures and disasters, actually, and even to the point of some siblings or brothers and sisters actually destroying financial assets and so forth. So the reality is you're trying to plan for the future of your disabled child who can't take care of themselves. They can't defend themselves. You can't leave the money directly to them because then the state will take it or whatever, or you'll disqualify them from benefits, right? So what happens when these disagreements come up? And I'll talk specifically about that in some cases that I'm intimately familiar with. So anyway, we'll do the first part of this for a few minutes, and then I'll end this video, and then I'll start another one. So let's just go down and talk a little bit about what is legacy planning. What am I talking about? So when you pass on, and just as a general note, I'm not an attorney. I'm a financial advisor. I work with attorneys. I have some partners that I work with. The reality is that you need to set up this legal framework, and it's a special needs trust, and there's a set of trusts that typically get set up. So there'll be a trust for you and your spouse, or you when you're alive, and your assets they're owned by the trust. So your house or your bank accounts, your 401ks, and all that kind of stuff. They're owned by the trust, and as part of that trust, you'll get a will, you'll get the powers of attorney, you'll get healthcare powers of attorney. So it'll take care of a lot of the legal aspects around what happens when you're dying or after you die. And then, so there's actually a series of trusts. So you have your own trust. It's a revocable living trust typically. And then when you pass on, the assets actually move from that living trust because you're not alive anymore. And that's your trust in it. And the assets that you've allocated will go into a special needs trust. And you need to do that to keep the government out of out of this situation, and especially because you can't leave any assets really to your loved one with special needs. You can't leave money with your disabled loved one, or you're going to disqualify them from government benefits like Medicare and medical benefits and maybe housing or whatever other kind of benefits that they're getting. So what you need to do is you have to have a trust, which means you have to have a trustee. And then inside your trust, you can talk about things like who's going to be the guardian and who's going to be the trustee. And it gives you an opportunity to outline the things that you want to happen with your assets to take care of your family and your loved ones. And you can be pretty directive, actually. But again, circumstances change, laws change. So you need to update your trust periodically, especially if the tax laws and stuff change. You might need to update it. But then you've got to, think about the financial plan that goes with your legal plan, because certain types of assets, when they go in the trust, are they taxable? Are you going to be exposed to estate tax or inheritance tax? Depends on how big your estate is. There's a few assets that you can put in there that are actually tax-free. And one of the things that a lot of people don't realize or understand is that special needs trust. So your trust, when you're alive, gets taxed at your own tax rate. So any earnings or income or, additional value that you're getting from your assets, it gets taxed at your own personal rate. You add it to your income tax and when you file and stuff. But most people don't understand that special needs trust that ends up taking over after you die, it gets taxed at the highest marginal tax rate. Right now, I think that's 39%. And so if you put money into this trust, certain kind of financial assets, stocks, bonds, and all that kind of stuff, real estate, besides the inheritance tax that can happen like right when you die, depending on how big your estate is, anything that trust earns is going to be taxed at the highest marginal tax rate. And right now, the government's trying to raise your tax rates. So, one of the financial strategies that I like to implement is targeting your special needs trust with tax-free money, so that it goes in there so that none of the earnings is taxed, that money is available, all of it is available, and also the financial assets in there are stable, safe, kind of secure assets. They make a decent return, but they don't lose money because that money has to last for 20, 25, 30, 40 years. You want it to grow, but you don't want to lose money. So those are some of the things that you need to be thinking about. So next time we'll talk about probate. And then after that, we're going to spend quite a bit of time on this circumstances change and disagreements and what can happen. Money does crazy things to some people. And so anyway, thanks for listening. I appreciate this opportunity to talk about this topic. And stay tuned and I'll get back and we'll go on to probate. See you later. Thanks. Again, educational and informational purposes only.